Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our FSC show, and we have the other components of some things that are really influencing what's happening on the ground, and we're going to talk about the IEA data as well. Tomorrow's my birthday, so my friend and partner at C6 was kind enough to come and take me out to lunch. So we've had a few beers, so it'll be a nice, fun conversation. And then next week we're going to talk. We're going to do our normal EIA econ, but we're also going to talk more about C6 and things that we're doing. So luckily enough, we've officially been accepted into COP28. So we will be representing the U.S. as well as in the UAE pavilion in Abu Dhabi at the end of this year. So things are definitely moving in the right direction, which is exciting, and we'll talk about that in more detail. So with that being said, we want to really kind of jump into the frac spread count. What does this mean going forward? So here you can see the frac spread count went up by 5, and you might be thinking, it's like, well, why would it go from 257 to 262? You know, you've had rigs come down, you've had some of these adjustments in general, but there's a lot more behind that. And the thing that we always like to look at when we're looking at this activity is, where is the activity happening? There was a bit of an increase in Anadarko. There was a bit of an increase in Appalachia. There was an increase in Western Gulf and Williston. And that's really where we've seen the biggest increase in what we talked about last week. The Permian is still on the lower end, and that's something that we do think is addressed as we go through really the rest of August. But mostly in September and October, we do see about 15 to 20 spreads becoming active in the Permian. But it's important to look at where and why. So for those that have seen or that have been following the potential strikes in Australia, all of a sudden natural gas prices exploded because there was a concern about LNG availability, and that's something where the U.S. can excel. And this is where we get into the IEA commentary. So for those that have seen me rant on this show, on the EIA show, in my insights, the IEA talks holistically about crude demand. So they said that crude demand is at 103 million barrels a day. The error that they make is they always talk about how 103 million is crude oil. It's not. A little bit less than half is natural gas liquids and liquids in general. And it's important to address the fact that the energy transition, the demand for plastics, the demand for these things is driving that oil demand growth. And the reason why we split it up, especially when we look at the frac spread count, when we look at what's happening in the US, is we don't have to produce oil to increase our liquids production. We have a lot of wet gas. I mean, if you look at some of the areas within the Delaware Basin, they're basically liquids. You know, maybe there's some oil cut, but there is a significant amount of condensate, or for those that know it, naphtha, heavy and light. There is the NGL, the natural gas liquid side. So we have to look at things on a different perspective. We've shown you on multiple different occasions on the EIA side, based on the economics as well as the energy data in general. Demand really isn't there to the same degree it was for gasoline, for diesel. Gasoline on structural and cyclical, but also diesel on more of a cyclical in terms of industrial manufacturing. Masrick has given us this huge red flag for exports. We talked about in the Econ show how China announced a huge drop in exports, imports. You know, South Korea so far has announced the same thing. So we're seeing this play out, but yet we're seeing this growth in demand. And again, we've shown you charts in these shows as well as in insights talking about how petrochemical demand is going higher. And as that goes higher, as that grows, you're going to see this number technically go up. So I think at some point, the energy transition individuals are going to have to recognize that demand is going up because of them. Because of the demand for petrochemicals, because of the new petrochemical facilities. It's not a black oil equation, it's a natural gas liquids equation, which I think is very important. Now, when we look at things from the rig perspective, here you can see that gas rigs dropped by 5, crude has stayed stable. But when you look at the horizontal dropped by 6. Again, get the hat tip to more drilling. He was definitely right in terms of the pressure that would come into it, where we thought it was going to settle around 605, 608 on the horizontal side. But here we have another drop. But again, you still had the increase in frac spread counts, and I think that's an important piece to look at in general. Louisiana had a drop of 2, Pennsylvania, Texas had a drop of 2, Oklahoma had an increase of 1. So when you look at it, again, Louisiana, Pennsylvania, and this is usually what happens this time of year. Obviously, gas prices have pared back down. That's something that we should see start to come back up, but that's more of a September, October thing. As at this point, we should have things kind of stabilize on the gas side and then start to pick up when you start looking at the crude side. And here's an interesting piece, and this is just looking at the weekly data from Mont Belvieu. You can see the recovery in pricing. And for those that have been following us on the EIA show, we talked about how LPG demand still remains fairly lackluster in the U.S., but on the international side, on the export side, it's very robust. And it's because of this demand from the petrochemicals, because all of that petchem was built in the Middle East. It was built in Asia, mostly China. So when you look at this expansion, we're sending all of this product abroad. And honestly, on a lot of different levels, Saudi Arabia helped us, because Saudi Arabia, by cutting their flow of oil, they've enabled the U.S. to really fill some of this gap in terms of the shortfalls on the LPG side. So even though we don't have the same demand we should have in the U.S., given where we are on storage, where we are in production, pricing at Mont Belvieu, that frac spread, the frac spread on a monetary basis, not the frac spread count from a completion side, but the frac spread from the spread of natural gas liquids, has gotten a lot of support, and that's going to help us in the long term when you look at that shift, because as we've been saying from the beginning, the next decade is going to be driven by liquids growth, not black oil, and that's something that we continue to see within the IEA. Now, when we look at gasoline demand, Asia Pacific got a little bit of love, which is cyclically. When you look at it on a cyclical basis, they normally get a nice little spike, and then things kind of drop off. That still remains the case. Europe continues to weaken. That is not something we had expected. For those that have dealt with Europe, it's not surprising to see them take off in August. August is a very slow month if you're trying to get something done. But again, this is way more of a drop than we were expecting. And then North America continues to, as you can see, start to see that slowdown. And a lot of that is because schools are starting up. People are going back to school. That typically accelerates till about August 15th. So really, this coming Monday is really the last kind of tranche of kids. And then there's a lull of 2 weeks. And then the Northeast and the Mid-Atlantic goes back to school either 2 days before Labor Day or the day after. China is starting to bottom out, but you can see this is not what we were expecting. We were expecting this to be a bit stronger. China, we did a very big deep dive last night on Twitter. I was going back and forth with several individuals, as well as the show where we talked about the issues that are striking China. It's not going away anytime soon, and this is going to be a pervasive issue in general. But one of the other things is, because everybody talks so much about crude flows and crude exports and the loss of them, but we always like to say it's a balanced approach. You have to look at everything in general. And so yes, China is importing a significant amount of crude, way more than they really need. But look at these exports. These are looking at refined product exports. It's a record amount of exports, and we still haven't gotten our third batch yet. So when we get the third batch, which should be announced in the next week or two, you're going to get an idea of, and how much additional exports are we going to get. And you have to look at both sides of the equation. It's not just a crude question. It's a crude as well as what are the refined products. Because if China is importing a ton of crude, but exporting a ton of product, well, that balances out, because that product is going to take margin down, and it's really going to undercut a lot of areas, specifically in Singapore, South Korea, Japan, which is why it's important to weigh the two of them when we're looking at the total picture. And here you can see Saudi Arabia, no different. Saudi Arabia is exporting a record amount of product. This is a huge shift. So yes, are they reducing the amount of oil they're flowing? Are they reducing the amount of oil product into the of oil flows into the market? Yes, but they're replacing it with product. So, but going back to 2014, that for those that know me, we've been saying that since 2014, Saudi Arabia's pivot was, why are we exporting crude when we can export a higher value product? What did they do? They closed a deal with Sabic. They've built more refining capacity. And here it is. Yes, are they reducing the amount of oil into the market? Absolutely. Especially the ones that the US needs, that Asia needs, that heavy, medium barrel. But they're turning around and exporting more product because they're driving up the price of the middle distillate, diesel, gas oil, for those that are paying attention. And this is where they're going out there and hitting that market. And Russia's no different. Russia has reduced the amount of crude in the market. They've increased the runs of their refiners. Therefore, there is more product to then put into the market, which is a higher value. It's also not sanctioned the same way as crude, making it a bit easier to get around things. So when you start looking at how this impacts the US, how this impacts individuals, the price of crude, the price of all of these different crack spreads have been driven up. So what does that do? That takes the price up for the consumer. So when you look at gasoline prices, when you look at diesel prices, you continue to see that trend up. And as we talked about it in this most recent econ show, it's going to be a tailwind for flexible inflation. Flexible inflation is driving higher, which is going to impact at a greater degree and to a greater extent, not only in terms of what happened at the end of July, but so far through the first 11 days of August, which is going to keep that, the inflation train moving up, that reacceleration, which is really not what you want to see going in September, which is when we have the next Fed rate hike decision. Now, India and a lot of these other nations are taking advantage of the discounted product coming from Russia. India is no different. India has, as you can see here, has taken a record amount of product coming into the market. The arrivals of the fuel from Russia jumped to the highest since at least the start of 2017. And that's not surprising. I mean, realistically, if you're India, it's like, okay, well, we're getting absolutely killed on the food side, so let's take the cheaper product, let's run that through the system, and we'll export the other product because, well, India's flag isn't banned the same way Russia's flag is, and that allows them to mitigate some of their inflation as well as capture some of that market. Top Russian fuel oil buyers, as you can see here, when you look at India, India is obviously continues to be the driver. China remains at the higher end, and we don't see that changing in general, just given the discounts that are in the market in general. So then when we start looking, as we talked about rice, for those that know me, I've been talking probably an uncomfortable amount about rice, and you're sitting there, it's like, why does this American care so much about white rice? Like, I mean, how much rice do you eat a day? Typically this is a problem for Asia, a problem for those staples. But again, about 3.3 billion people rely on rice as a staple, if not base, for their food. And this just shows you the amount of caloric intake in terms of rice. And you can see, obviously, it's weighted significantly to Asia. We had the issues with India. We've had the issues that we talked about again last week. In this previous econ show, where you see the rice degradation, you see the lack of availability, which is driving up pricing, and that creates inflation. That creates other problems. And as we showed in the econ show segment 1, India has a huge exposure to this inflationary cycle. And again, that's going to be a driver where they're like, well, we need cheaper crude to offset the rise in food inflation. And that's something that we're seeing them balance out, which is why we're seeing more Russian product pulled down to try to offset some of these big increases on the inflationary standpoint. And now taking that back to the sticky price, flexible price in the US, here you can see that the sticky CPI, 1 month annualized, 3 month, 12 month, is a problem. It's not going down. And as we've said, it would stagnate, and here it is. It's stagnating here, and you're not getting this meaningful drop that the Fed wants, that some of these other individuals want, which we're going to talk about in a minute when we start looking at some of the ways that this compares to the 1970s. So then when you look at flexible, when you look at the flexible equation, here you can see that the flexible has come down on a 12-month annualized basis, 3-month annualized basis. You were actually in the deflationary standpoint because flexible had fallen. That was the driver for the reduction in inflation. But now you're actually seeing that turn up. And remember, the increase in pricing, especially on the crude front, didn't really accelerate until we got to the end of July and then started to make that whole new move up, which we saw, and we continue to see that reacceleration through August. And at this point, doesn't look like it's going to stop in the near term. So then when you look at the contribution, and U.S. inflation is now about housing, but it's not just about housing as well. It's also about other components that we talked about when you look at labor, when you look at the impact from the fact that labor continues to accelerate higher a bit. We had PPI, which, as we've talked about in the past, is a leading indicator of inflation, and PPI reaccelerated. It came in above estimates, which does not bode well for what things are going to be in August or September, and that's where we see some of that stickiness. Now, for those that have seen it, we'll talk more about it in the Econ show. We've had some people have started to measure the current inflation and rate situation against the 1970s. Now, this was the precipice where in the 70s, they started to cut because they're looking at this and saying, well, the trend is the right way. Things are moving in the right direction. The economy is slowing. We should cut. And they did. And then what happened? You had this massive reacceleration into the end of the 70s, which then brought about this massive increase in wage spirals, which then brought Volcker, which brought 22% interest rates. Powell, like him or hate him, he's not a stupid individual. He is sitting there, and as we've been saying, he's looking at this and saying, we are going to learn from our past mistakes. We're not going to cut. We're going to keep it where it is. And I think the dollar is starting to show you, as we said when it broke 100, this isn't the death of the dollar. The dollar is going to bounce. It's going to live in this 100 to 103 category, and that's what we continue to see. And the Eurozone is a problem. The Eurozone has not just a housing issue, but while the U.S. is a bit more focused on housing in terms of inflationary drivers, Europe has way more. They have a bigger impact from the energy basket, which continues to hit. Now, when we look at the U.S., here you can see that Zillow signed rents are declining. Vacancy rates are also rising. So typically, this starts to see this pattern of shift where rent should come down a bit. We have new supply coming in, and as we talked about in this past Econ show, it makes more sense to rent versus buy, just given the different variables that sit there. And this helps to show you that huge pipeline of apartment supplies. We've talked about it multiple times. We've taken out the 1973 highs. There is a lot of volume coming to the market. So yes, prices remain elevated for homes, for all these other components, but that is going to change as these new units come to market. So again, it's just going to take time. And as that comes down, we're going to see that deflationary component, which we thought was going to start to rear its head now and accelerate into Q1 of 24. But given this reacceleration in inflation, we think that inflation is going to last longer, which then would lead to that deflation before we finally start to get some of that disinflation before we get that deflation. So that's what we have for you today. If you have any questions, please let us know. We hope you have a great weekend, and thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.